Well, let's focus on what's driving the local market. Wayne McCurrie from Momentum Investments still with me at the desk. Wayne, what's caught your eye on the market this week?
Well, what's caught my eye was, do you get one shoe or two shoes for $500,000 worth of diamonds on it?
I don't know. I just wish I could afford those shoes.
Okay. Well, if you get one shoe, it's not much good. But yeah, what's caught my eye? Strong rand. Plenty of new highs on the market. Much better sentiment around the market. A bit of a recovery, certainly in the building and construction shares. Banks looking quite good. I like the ABSA deal. I mean, you've got to get growth into Africa. Ultimately, Africa will be the savior, or the not the savior, but the growth prospects for our domestic companies, because other markets are quite frankly just too far away. So that's very, very good news for ABSA. The banks look reasonable value. I mean, we spoke about the current account a deficit quite extensively earlier on. But yeah, it was a good week, and I think we're going to see a little bit more of the same. Maybe not the equity market being quite as strong, but I think the rand's going to continue strengthening a little bit. It was way oversold in the shorter term because of all the things that have happened here in South Africa. So we could see a little bit of strength, maybe another 10 cents or so before the end of the year. And quite frankly, the All Share could put in another couple of 100 points and hit a new high before the end of the year. But then the question is the share market value or not? And I must admit, at the 39,000 odd level, you're starting to approach expensive territory. There's no need to panic, there's no need to worry yet, but this is not a cheap market at these levels.
Now let's talk about Tiger Brands, because this is a stock that is literally at a new record high. It's 311 Rand is the high, so it's 5 cents away from that today. But it's had a fantastic run, even in light of the fact that its key markets here in South Africa has seen volumes declining. As you know, it's kind of volumes have been eroded by the fact that people are looking at cheap alternatives at private store labels. But it's continuing to make acquisitions, buying Mrs. Bull's chutney for 475 million Rand.
I must say, it
seems
quite cheap. Seems quite cheap for Mrs. Bull's chutney.
It excludes inventories, but I mean, ultimately...
They're just paying for the brand name of that. Look, Tigers is a very good company. It is cyclical. It is commodity based. It's not as cyclical as, let's say, AFGRI and the true commodity producers, Tongaat, etc. But 18 PE, this is not cheap for Tigers. Tigers doesn't trade at this sort of premium. At the moment, they are experiencing some margin pressure. Their margins 2 or 3 years ago were astronomically high margins, but now with food inflation, and unfortunately there's no good news coming on food inflation for a long time, that they just won't be able to pass the price onto consumers. They're going to have to take their margins back. So I think you can own Tigers in your portfolio because it is a very, very good company, but I would clearly not be overweight at an 18 PE. It's just not value at this level.
Do you like any of the kind of food stocks? Because I mean, Tiger's not really a food retailer.
No,
but
it's got fast-moving consumer goods. It's got brand names. It's not. It doesn't just produce milli meal by the 50-kilogram packet. You know, so
it's not an agricultural stock.
But there are a lot of commodity foods in their basket. But you can go with Tigers. You can go with Pioneer. But the pure, raw agricultural commodity producers I don't like. I think your margins are bitterly small, and also there's massive competition. So Rainbow has changed now with the whole deal with Food Corp. That's a very different company. But AFGRI, Tongaat, the sugar companies, I'm a little bit skeptical. They're too cyclical, these businesses.
Well, let's just go back to this banking sector, because I mean, ABSA is sitting with a 8%, almost 8% gain, 7.7% gain on the week. And you know, this is a stock that 2 months ago was completely out of favor in the market, and you know, fortunes have turned, and it seems like Bank is now a bit out of favor.
2 or 3 years ago, the banks, no one wanted to touch them in the midst of the financial crisis. These PEs got to 8. That was the time to buy them. Now we've had a massive run in the banking shares. In fact, I think the banking sector is the best performer this year, or one of the best performers this year.
And Moody's downgrading the outlook for South African banks.
That's because of South Africa's been downgraded. So people aren't too worried. Our banks are fully capitalized. There's no capital risk in our banking system. They're just downgrading it because they part of South Africa, and South Africa was downgraded. So that doesn't worry me at all. But we've seen extremely good earnings growth. So despite the big rally, the PE hasn't risen much in the banking sector. It was about 11. Now, ABSA had all the fun and games a couple of months ago, and the market hated it, and they walloped the share. I mean, the share took a pounding. But the PE got to 7 or 8 and it looked quite cheap. Now this whole new deal has revitalized ABSA and the share price is going up. But remember, everything's in cycles. A couple of years ago, Standard Bank, you couldn't touch it and FirstRand was the dog. Now FirstRand you can't touch and Standard Bank and ABSA are the dogs. So these things go in cycles. But at an 11, 12 PE, you can still own the banks. They are reasonably good value.
Still buying them.
Oh, yeah.
Yeah.
You can do that because they're reasonable value, and we are not going to see an increase in interest rates for a long time here in South Africa.
You got to worry about the bad debt side of things, though.
They're not that exposed to the unsecured market. FirstRand, I think FirstRand's total book is about 4 or 5 billion total exposure to the unsecured credit. You've got to watch in other smaller players for the bad debts, not so much. In any case, bad debts never burn you until interest rates go up.